Doesn't matter, man.
I just don't want to get mistaken for a Packer fan.
All right, welcome to Whiskey and Real Estate. I am very excited to be back. I'm Alex Peterson, your local real estate expert here in the Western Chicago suburbs. And today, I've got my good buddy, Phil Bukowski, with me. He's with the Money Store. He is a lender. And tonight, while we are sampling whiskeys, we are going to be talking about pre-approvals. So cheers to another good night,
Cheers,
and let's enjoy.
Spicy cornflakes.
Yeah, I get a lot of corn. It's got a little bit of a spice on the front there too. It sits on my tongue nicely. The viscosity is nice.
Yeah, I still get jalapeno cornflakes.
Jalapeno cornflakes.
There's something almost vegetably about it, you know?
We're gonna keep sipping this as we go. Phil, what is the difference between a pre-approval and a pre-qualification?
Oh boy, there's a big difference. A lot of people think that they're getting pre-approved when they're actually getting pre-qualified. Pre-qualification is based on two things. One, a loan application. That's like, who are you? Where do you live? What do you do for a living? Where's your money? Etc. Then there's a credit check. So that's 2 out of the 3 things needed for a pre-approval. The pre-approval adds in a document review. So you being a realtor, I know you're self-employed. I'd want to look at your tax returns. Make sure everything there looks good. Or people who use bonus income, commission, tips, things like that. We always have to take an average of that income. So getting pre-approved means I've looked at your documents and verified that you're set from a credit, income, and asset standpoint, and you won't run into any issues once you're under contract. Whereas pre-qualifications don't do that extra step, which we know how it goes in real estate sometimes.
Yes, we
can
do.
lead to some trouble.
Yes, it can. So oftentimes if you talk to somebody and they maybe went through like an online portal and they're like, oh, well, I already got pre-approved for like $450. What is your first question when you hear that from somebody?
By who?
That's reasonable. Oftentimes, it'll be, some of the big guys. We're not going to point fingers or give any grief to any of them. They're usually really quick and they do 5 minutes. You've got your pre-approval.
Yep.
In your experience, those are typically going to be more of a pre-qualification because there's not time to review those docs, right?
If you haven't sent in your documents and there hasn't been enough time to actually look at them, then no, it's a pre-qualification.
Got it. Now, on my side, pre-qualification versus pre-approval makes a very big difference too, because if I'm a listing agent and I get someone who submits an offer with a pre-qualified letter, I treat that like garbage, which is
not worth the paper it's printed on.
Exactly. And the reason for that is exactly what you said. They haven't verified anything. And I think that's one of the things that a lot of people don't understand and they don't realize is like, you show up, you get your pre-qualification, that's great. They're going to ballpark you, and that's not a terrible starting point. But the reality is you're self-reporting that income that you're punching into their system. So, I mean, for all they care, I can show up as a realtor who's 1099, and you definitely need to review my numbers. And realtors are notorious for, as with most 1099 people, to just take as many deductions as possible, lower the taxable income. And the reality is, then when it comes to my pre-approval, though, as a 1099 employee, if I've taken 1 million deductions on my pre-qualification, I can say, I make $250,000 a year.
You got it.
But then you sit down, and what docs are you going to ask me for as a 1099 guy?
Tax returns.
Just the tax returns.
That's the most important thing. Well, it depends on what type of business you are, right? Sometimes people are C Corps, S Corps, partnerships, LLCs, different things like that. So it's going to kind of come down to what type of business structure you have. Okay. But more often than not, when you're self-employed, your tax returns kind of tell me everything.
Yeah. And so do you run into that, though, where you'll see a self-employed person who has deducted every penny they possibly could, and their income went from $250 down to $75,000, and you're like, you can't buy this $1 million house that you want or this $750 house that you want because you're making $75,000 a year as far as the bank is concerned.
Yeah, it's very common. A lot of times when you ask people what they make who are self-employed, they give you the top line number, not the bottom line.
Yeah.
Which we qualify on the bottom line number. And generally, we're going to take a 2-year average. So let's say that, 1 year you lost $50,000 and next year you made $100,000. Well, that nets to $50,000, doesn't it?
Yes.
That can be kind of tough, right, to be able to qualify for a mortgage on that. So It's just remembering that when you're self-employed, specifically self-employed, and you're looking to take out a mortgage, generally have that 24-month time frame outlook on it. And also just understand if you are looking to really know that you're putting an offer in on a home and you're not going to run into trouble, that you've had your documents looked at, whether you're self-employed or not. And if you're not, your W-2s, your pay stubs, things like that.
So with those W-2 employees, how long do they need to be at that job before you can realistically approve them?
Yeah, it's a good question. So that comes down to whether it's a conventional loan, which is a non-government based loan, or an FHA loan. They have slightly different rules as to how long they want you to be there. And also it comes down to, are you salaried or are you hourly, right? And if you're hourly, do your hours vary from paycheck to paycheck? I'll give you a common example. Nurses. We love nurses. I love working with nurses, but they are notorious for having many different types of shift differentials and sometimes fluctuating hours, right? Depending on what's needed. So when it comes to how long do you need to be on that job, generally speaking, if it's a salaried job, we can use that almost immediately. Whereas when it's hourly, if it's not explicitly 40 hours a week every week, you can kind of dip into this variable category, which can get dicey at times, especially on FHA.
Got it. So have you run into that though, where you've had someone who's maybe working a 40-hour-a-week job typically, but they have those 30, 35-hour throw-in-theirs, but they don't let you know that up front, and then you figure that out in review, and that kind of sets things up?
So one of the things that a good loan originator is going to do is they're going to say, okay, you're full-time at 40 hours at X pay rate, right? Generally, pay stubs are going to show a year-to-date pay. Well, if we know what the pay date was, and we know the start of the year is January 1st, we can do a calculation to see, are you tracking above, at, or below where you should be? And when it comes in below, I have to ask you further questions, don't I?
How often do you think loan originators do that? Because that seems like an extra step that would be for the elite category, the ones that are going to put in the extra work. But how often do you think that actually happens?
Not very often.
When did you start doing that?
Immediately. But I had a fantastic mentor. Shout out to Ken Webster.
Yes. So. Ken's fantastic. He runs a great office.
He does.
Very big fan of that guy. Why would you recommend getting pre-approved as a lender before they start, dipping into Zillow? Because we know everybody loves trolling Zillow. Clicking through those $1 million homes is a lot of fun.
It is.
When you're getting serious about shopping, why, from a lender's perspective, would you recommend that?
First thing, when it comes to pre-approval, there's no downside. There's never a cost for a pre-approval. A lot of lenders can do pre-approvals on soft credit checks that do not hurt your credit scores.
I was going to say, I want to pause there on that. Soft versus hard pull. A lot of people don't understand the difference, and their biggest concern when they're getting a pre-approval is, well, I don't want my credit to get messed up.
A hard credit check means we're, generally speaking, checking all three credit bureaus, Experian, TransUnion, and Equifax. And what happens is, when we pull that hard credit, right, there's always going to be an impact on your score. Never going to be a positive one.
Yeah.
Right? It's always going to be a negative one. And a lot of times,
just to know your score, they're going to give you crap for it.
Yes. And a lot of times people think that it's going to really harm your score significantly. And the truth is, it's variable, right? If you've had your credit pulled 15 times in the last 6 months, it's going to hit you a little bit harder than somebody who hasn't had their credit pulled quite as frequently. It's also going to depend on the length of credit history you have. If you were a 60-year-old version of Alex Peterson who has this length of credit history, a pull shouldn't impact you as somebody who has just recently established credit, right? But that's what that hard check does is, there is an impact to your score, but in order to close on a mortgage, to actually go through underwriting, get the funds and close on a house, there needs to be a hard credit check. So the nice thing about the soft credit check is we can generally issue conventional pre-approvals on a soft check and not need to do that hard check until they're under contract to buy a house, which doesn't ding their scores along the way. Again, there's no downside to them getting the pre-approval in place. If there were a cost, I would totally understand that, but this just gives you certainty as to what you can afford. And for consumers, the hardest thing to understand is, I want a payment of X, right?
Yeah.
What does that correlate to in the value of a home? You're not going to know that. That's why going through that process helps me say, hey, you want this payment, you have this much to put down, and here are your credit scores. This is the range of homes we should focus on, not above, because now you're no longer in that comfortable zone. For you, if somebody comes to you and they're looking at $500,000 houses, and they've already been looking and doing all that, and then I tell them they qualify for $250,000, it's really hard to put that toothpaste back in that tube.
Yep.
Start with the lending side so that you know exactly what you should be looking at, because doing it in the reverse order is really hard.
It is, and that's one of the things that I preach to all my clients. When we sit down for a buyer consultation, my first piece to the puzzle is like, look, meet with your realtor. That's great. We're getting the ball rolling. We're setting up. But the number one stuff after you talk to me is, I need you to talk to a lender. We cannot start looking until you've got a realistic idea of budget. I've had quite a few clients, though, that are just blown away by what a bank will give them. So maybe we can talk a little bit about how they determine that max amount that they're going to give you.
It's actually super easy. And by the way, still jalapenos and cornbread.
Jalapeno and cornbread.
I don't know what's going on.
Man.
But, yeah.
It's very tasty, though.
It's wonderful.
I wasn't sure what to expect.
It's a good pick, whatever it is.
I'm a happy guy right now.
I'm a happy guy too. So what you qualify for, and this is something I teach to realtors like yourself, I teach to my first time buyers. Gosh, how many times have you heard me talk about debt to income ratio?
Oh man.
All the time.
Since day one, when we first met, after I had just gotten licensed, talking about, we call it DTI.
Should get a tattoo.
Just put it there. That debt to income, that is the king when it comes to figuring out what you can afford.
So it's a very simple fraction, right? On the top, we're going to have your monthly debts, okay? And I don't mean like your Netflix bill and what you're spending in childcare and things like that. It's more so, what are the monthly debts on your credit report? So credit card payments, auto loans, student loans, etc. You add those up. What you then add into that number is your housing payment that you want. Let's say that you and Jarrell were looking to buy a home, right? Mm-hmm. And you're saying, hey, we're comfortable at $3,000 or $2,000 a month. Whatever number that is, you would add that into those monthly debts. And now we have the top of our fraction figured out. On the bottom, we put your monthly income. Now, if you're a W-2 employee, it's based on gross income. You're self-employed, it's based on net income.
I want to make sure everybody heard that. 1099, net income.
Bingo.
W-2, gross income.
You got it.
This makes a big difference in your buying power, because $100,000 a year W-2 is going to have more buying power than $100,000 1099 employee.
Unless you took zero deductions, yes.
Unless you took zero deductions, which, let's be honest, I'm not sure I've ever run into a 1099 employee who didn't take a deduction.
You don't see that, no. But when you divide those debts by that income, it's going to give you a certain number, and you want that number or percentage to be under 50%, generally speaking. The lower, the better. Conventional loans have a max of right around 50%, sometimes tiny bit higher. You can win on the margins there a little bit. FHA, you can go actually considerably higher. You can go to 56, 57% in some instances. And VA loans have no defined limit, right? It's more so when you go through the automated underwriting process, do you get an approval, yes or no? But again, generally speaking, we're not trying to max out our budget, but that's how you calculate your debt to income ratio. And generally speaking, if you're under 50% or 45 or 40%, those are kind of key thresholds. Staying under that is always a smart idea.
Yeah. All right, so we need to figure out what this is, because this is fantastic. Let's grab the bottle and reveal this bad boy. All right. Hey. We have Knob Creek's single barrel selection. This was a private selection. Warehouse L, floor 2, Rick 16.
That's my favorite warehouse.
10 year. This was originally barreled May of 2014 and selected in September of 2024.
Let me see this bad boy.
So this is
Beam, yeah?
Yes.
They make good stuff. Beam hits my palate well, I've found.
Now what's interesting to me, this is a higher proof, and yet I didn't feel just smashed with it. Sometimes I know a lot of people love their high proof bourbons. Personally, anytime I clear that 50% alcohol, the 100 proof stuff, it tends to start to get to me sometimes. And it overpowers me too much, and I want a little bit of water, a little bit of ice, something to open it up.
I'm in my kind of happy zone around like 110 to 120.
Well, then this would be right in there because I think this is a 120.
Yeah.
Yes, it is.
See?
That makes sense that you would be happy in this zone.
Yep.
I think we need glass 2.
Let's do it.
We'll get going on bottle 2. All right, we are back. We've got glass number 2. Cheers to round 2, man. That is much softer on the nose.
That smells so silky.
I get
Oh my gosh, it's like silk pajamas. I just want to slide into it, you know?
It's like candied apple. I get a lot of sweetness, a lot of fruit, floral. It's very bright.
That's really wonderful. Wow. I feel like I'm on a roller coaster of flavor.
That is very different
That is very
from that
different.
first one.
Proof points are similar, I would imagine, though. Based on that finish?
You know what? It's probably the wheat, because I think this is probably something with wheat.
It's a
The
weeder.
sweetness in there is definitely strong. So that's probably what's making me
Oh my gosh, just
bring the proofing point down in my brain.
so much caramel on the nose.
I know. It's amazing.
Oh my gosh, decadent.
I'm telling you, that carameled apple hit.
That's delightful.
I'm a happy guy. We'll reveal that one later. But let's get back at it. So the documents you need. What do you need from someone? What documents should they have ready to go so when they call you, they can hop?
Yep. To give you a generalized list that's going to meet both W-2 and self-employed individuals, it's going to be 2 years of tax returns, 2 years of W-2s, most recent 30 days worth of pay stubs, 2 most recent bank statements, photo IDs, and if you already own a home, mortgage statement, homeowner's insurance, and proof of HOA dues. That is the list right there.
Perfect.
Now, can we branch off of there? Perhaps you're not a U.S. citizen, but a permanent resident. I'm going to need your green card. Maybe you're getting gift funds. That's something that we have to kind of coordinate up front, right? So, although there can be variations from that list, that is the base right there.
Perfect. So if I get my documents to you, we go through the pre-approval process, and I find out you're telling me I can only afford a $250,000 house, but I need a 3-bedroom, 2-bath house for my family. Is there anything at all we can do about that?
So that's a challenging situation, and one that, you know, especially since 2020 and 2021, I mean, we were at historically low rates.
Yeah.
In people who have those now and then are looking to buy subsequent homes, there is that kind of feeling of, oh my gosh, I don't want to leave this rate behind, and it's so much harder to qualify, and that can be true. But as a lender, part of my job is also figuring out, do you have other types of income that I can use? Are we looking under every rock, right? There's really, really creative things that we can do to maximize your income, whether it be using assets as income, perhaps you're retired, setting up an IRA distribution or something like that as qualifying income. But if none of those are, you know, possible, and it's just, hey, very simple, here's my income, I don't make enough, what should I do? A lot of times at that point, you're going to a cosigner. The number one thing people think in their mind, well, I'll just put more down, but here's the thing. Depending on where rates are, an extra $1,000 towards your mortgage is only going to change your monthly payment by about $6.50, $6.75.
Yeah.
So you're not going to see this huge difference. So more often than not, it involves bringing in a cosigner, which on a mortgage is a little bit different than a cosigner for like a vehicle. A cosigner on a mortgage is a full-on borrower, and they are there strictly to help for income or asset purposes, typically income, where they make a very healthy income. It helps your, remember our fraction, debt to income calculation. And down the road, as your income or your debt decreases, you can, of course, then refinance and remove that person from the loan.
Okay, so you can remove somebody from the loan down the road.
With a refinance. Generally speaking, there's some exceptions to that, but generally, yes.
Now, what happens if my cosigner has a terrible credit score?
Yeah, that's tough. That makes things much harder than the income problem, actually, because when I'm always looking at qualifying individuals, I usually start by looking at credit score, and I start there because it's a hard stop. Under certain thresholds, it's just kind of like a no-fly zone.
So let's talk about those real quick. Let's talk about those no-fly zones. What are those baseline credit scores? What's the bare minimum that you got to be functioning with?
The true base is a 550 or higher, and it's for what's called a manual underwrite. and they are extremely challenging to get done.
That fall under FHA or conventional?
That falls under FHA.
Okay.
And so generally speaking, with an FHA, you want 2 scores of 580 or higher. They go through a process called automated underwriting. So we submit it to either Fannie Mae or Freddie Mac.
So we're talking 580 is really the realistic bottom for FHA. You can dip underneath that, but it does require a lot more hand-holding, a lot more legwork.
And what's going to happen too, I mean, credit score works on a bucket system, okay? Where every 20-point difference, it saves you a ton of money. 580 to 599, you're in the same bucket. Once you hit 600, you're in a new one. 600 to 619, same bucket. Once you hit 620, you're in a new one. And so what you're going to find is, although 2 scores of 580 is the minimum threshold, generally speaking, getting to 600 drastically improves your chances of qualifying for that mortgage, and is also going to save you literally thousands, if not tens of thousands of dollars over the life of the loan. Same thing from 600 to 620, and each time you make that step up, things just get better. And so when people ask me, it's like, hey, am I across the minimum threshold to be able to do this? Yes, but part of my job as a professional is also saying, at what point am I helping you maximize what you're doing and the timing of that? And that's different for everybody, but that's also something that people need to be educated on. Just getting over that minimum threshold for some people, it's not good enough. We want to be able to save you as much as we can and put you in the best position possible. And so that's where talking to a loan professional who really knows what they're doing really matters, because we are talking about a lot of money, just 20-point difference.
Conventional then, where's the conventional bottom out?
Yeah, generally speaking, 600, and it's very similar to FHA. Again, every 20 points, except conventional places a very heavy emphasis on credit score. FHA is a lot more forgiving on credit score, whereas conventional's the nun slapping you across the hand with a ruler, okay? Like, generally speaking, they are going to prefer higher credit scores when it comes to interest rates, mortgage insurance, things like that.
Okay, so if I had a 620 credit score, it's possible that an FHA loan may still be a better option for me than a conventional loan.
Oh yeah. I've had some really unique instances where we had people with lower credit scores and larger down payments where it still made more sense to go with an FHA loan than a conventional, just because of that difference, that big difference that you're going to find in the interest rate. Now, that's not true for everybody, but generally speaking, if you're looking to make a smaller down payment and you have a, lesser credit score, FHA is going to be your best friend there. Whereas conventional, they really do hammer you for credit scores in a way that FHA doesn't.
That's really an interesting piece, because I get some people, I've had conversations in like buyer presentations, they're like, but FHA loans are for people with bad credit. And so there's like this misconception that like the FHA loan is a product for people that really shouldn't be qualified, that are getting loans.
No.
And ironically, my first loan, actually, with my wife and I, we were in an FHA loan. We actually got down payment assistance on our first house, and that was great. It saved us a lot of money on the front side. We put the 3.5 down. But with the down payment assistance, I want to say we spent less than $5,000 to get into our first house, which was great. I mean, we were both just graduated college. I had student loans, my wife didn't. But we had a little bit of debt there. And so we didn't have a ton of money to work with. But we were able to piece that all together, and the FHA loan was just what we needed at that moment.
Yeah, something that should be cleared up is FHA loans are not worse than conventional. They're just different, right? And every borrower's situation is going to be a little different, every buyer's situation, right? And generally speaking, you should choose what gives you the best payment.
Great advice. Now, is there a top on conventional loans? Because you say they put a really high, priority on that credit score.
780.
780. So once you clear that 780, it doesn't matter if you're 790, 815. They don't care at that point. 780.
I had somebody tell me they had a 900 credit score recently.
That's interesting.
And I said, that's actually not possible, but good for you.
So for our viewers, where does it top out? What is the highest credit score you can get?
So each bureau has a different high. Let me first kind of get on my soapbox here about credit score.
Do it.
There's a lot of different types of credit scores. For example, a lot of times when I talk to people, I say, how do you monitor your credit? And they say, like Credit Karma. Credit Karma, hey, it's great to monitor your scores on, but you have to understand what they're showing you is something called a Vantage score. That is not something that a lender like myself is going to look at or use. We use something called FICO score. FICO is through a company called Fair Isaac. It's proprietary, has a cost. The reason lenders use it is because it's a little bit more, I guess, sophisticated for lending purposes. So when you're looking at like a Credit Karma, you're not going to see the same scores that I do. They're also going to have different highs and different lows. And that's why somebody told me the other day, I have a 900 credit score. On whatever model they were looking at, sure, they could have had a 900 credit score. Within FICO, it's not actually possible. Now here's where things get interesting. Within that FICO model, there's a bunch of different versions. 1, 2, 3, 4, 5, 6, 7, 8. And so the chances that you know where those different models within FICO, like where your scores are, is very low. Because TransUnion, right? They use FICO, I think it's FICO 4. Experian uses FICO 2. You're not going to know where these things are. They have different highs and lows. To get back to your original question. I want to say Equifax is like an 839. TransUnion's like an 844, something like that. I wish I had it in front of me because I'm sure somebody here is going to fact check me, but you get the idea.
I mean, that's exactly what you want on one of these things, right? You want somebody in the comments telling us that you're wrong.
Yes.
So now on my side of things, as a realtor, it's really important for when I'm having conversations with lenders to be able to ask questions. And I try to probe as much as possible as a listing agent.
Should.
Now, as a lender, your responsibilities to your buyer clients. Now, how open are you required to be with a listing agent about the financial positions of said buyer?
At the end of the day, there is nothing that I necessarily need to share with a listing agent, but one thing I can verify, the more that I can tell that listing agent, hey, there may be some hair on this one, right? There may be some wrinkles here, but I've done my homework. I do it every time. This is gonna close, and it's not a problem, and here's why. That's all they care about. That's all you care about.
It's true.
Did you look at everything, or is something gonna bite us in the behind?
Right.
It's not. That's why we always tell people, if you get a letter from us, you're good to go. We looked at everything. As we said before, it's not always the case.
It's true. It's true. Too often I run into lenders who have just plugged some numbers into the automated underwriting system, and they think that's sufficient, and they still haven't reviewed all the docs. They haven't pulled everything. And we get under contract and it's like, well, this is great. We have a hiccup, and now a co-borrower is getting added, and a co-borrower is getting taken off, and a new co-borrower is being added, and we've turned it into...
They're going through all their cousins and best friends, and
Yes.
Yeah, I've been there.
How long have you been in the business? Because I know that's going to be of interest.
I actually got in the business in 2012, but on the corporate side, I started in this business as an underwriter. So
really?
That's where a lot of those good habits came into play.
Interesting.
And I did that for about 3 years, and then I transitioned over to being a loan originator.
So that's not a normal process. Most people just go straight to originator.
Yes.
And they have not been an underwriter. Now, for all of us normal people who really don't live in the financial mortgage world, what is the difference between a mortgage underwriter and a loan originator?
Yeah, so a mortgage underwriter is somebody who assesses risk. They're the ones who are looking at every little nook and cranny of your qualifications, from credit to background to income to assets to the property. They are the ones making sure that if their bank issues a mortgage on that property to these borrowers, they've looked at everything to ensure they're meeting those Fannie Mae and Freddie Mac guidelines so that that loan can be bought and insured. That's the number one thing people care about. If an underwriter doesn't do their job, that can create problems. But that's what an underwriter does. Realistically, that should be very similar to what a loan originator does. Now, we might not go as in depth as an underwriter does, but it is our job to make sure from the things that we can see and access at this point in time about our customer that it's not going to be a problem. Similar to being a realtor, being a lender, there's also a sales component, right? We have to get out there and shake hands, kiss babies, and do sales, right? But realistically, that's the key difference. Is the underwriter strictly just looking? They're in the minutia. The loan originator is also in the minutia, but also doing the lead generating and things like that.
So what's the best advice you have for somebody who wants to buy a house here in 2025? and they're not sure where to start,
Stop waiting.
what to do.
Stop waiting.
Just stop waiting. But the interest rates have been trending up.
Stop
Phil.
waiting. No. You know what? You know what's interesting? I love that you said that, right? There's certain things that just, get me going. And one of those things is about interest rates. And people who financed in 2020, 2021, and they got these historic all-time lows that people think are just the norm, and they are not. Actually, where we're at is actually a very healthy market. And I don't think these interest rates are really going anywhere. People keep saying, I think rates are going to be lower. They're going to be back in the 4s, back in the 5s, maybe. Here's one thing I can tell you. One of the main things, really the main thing that drives mortgage interest rate is technical data. What do I mean by that? Jobs, inflation. Those two things right there, those are the one and two things that affect what the Fed is going to do.
So when the Fed lowers their rate, though, the interest rate drops.
No, it does not. The Fed changing their rate and mortgage rates are two different things. They're not like, hey, the Fed dropped rates, now my mortgage rate went down the next day. Not at all true. That's a discussion for another video.
It is, because we could go into a lot of details, because even just this last, cycle, rates have been dropped, and mortgage rates
increased.
They dipped prior to the drop, and then when it dropped, mortgage rates have trended up almost exclusively since then.
Buy the rumor, sell the news, right? It's an adage in finance as old as time. When people are anticipating that federal rate cut, we see mortgage rates move lower. When the cut actually happens, we see rates go up. I don't know if you read my newsletter. It's a great newsletter. I predicted that, did I not?
You did.
I think these rates are here. We're not seeing, for better or worse, we're not seeing an economy that is crippled by a lack of jobs. We're not seeing very high unemployment rates. We are seeing inflation that is in excess of where we want it to be. And all three of those key things dictate higher rates for longer. So if you're waiting for the shoe to drop and to say, oh, I need that 5% rate, don't hold your breath. What's going on here is we're probably going to see home values increase again in 2025, in probably 2026.
And I would agree wholeheartedly with you from the real estate side. I mean, we're still seeing inventory shortages. We're still seeing multiple offers in this area. Home prices in DuPage County last year grew by 9.5% as a median sales price. And in Kane County, which is another county that I do a lot of work in, it grew by over 7%. Now, historically, we see 3% property value growth as normal. That would be a standard, historically traditional spot to be. 9% is big. 9% increase. If you've got a $500,000 house, that's $45,000. You just saw your property value increase in 1 year.
And the hard part is, everybody's waiting. Oh, these rates are so high. These rates are so high. But again, historically speaking, they are not so high. We are in a fairly healthy, at least interest rate market. Would we love to see more inventory on the sales side? Sure. Of course. That doesn't just happen overnight.
I'm sure you're all very curious as to what we were drinking. So
whatever it was, it's gone. It was lovely.
I finished mine a while ago too, and I'm sitting here like,
oh, you're doing the fake sips?
I've been hoping that more just magically shows up in the bottom of the glass there. Let me grab that and we can reveal that one. All right, so we have Maker's Mark Cellar Aged 2024 release. This is a harder bottle to find. This is not something that you're just going to walk into Benny's and pick up on the shelf. And
probably not.
You were right in the same vein. That was 120. This is just shy at 119.3. So very similar. Way to go. The difference on this one's aged a little longer, which is why I felt a little bit more complexity in there. We've got 12 and 13 years, so it's a 85% 13 year and a 15% 12 year. So just over that 10. This is very tasty. A lot more wheat though.
If you're a fan of Maker's Mark, this is something to chase down.
Down payment amounts. We didn't talk about that, and that's something that I really do think is important because a lot of people, as they're preparing to get a mortgage, the traditional age-old rule of thumb is 20% down. Of the loans that you did last year, what percent were 20% down?
Maybe a third.
Okay. More
often than not, the average down payment for first-time home buyers, at least last I checked, was about 6%.
Yep. 6%. So if you're sitting there thinking, hey, I want to be able to own a property and I'm tired of paying rent, and rent, at least within the Chicagoland area, these western suburbs, it's skyrocketed. If you're looking at $200,000-$300,000 property, let's use 250 for middle of the road point there. You can get a decent 1.5 bath, 1 bedroom, 2 bedroom place, condo, starter spot in that $250,000 range. How much money is someone realistically, ballpark, going to need for something like that if we're putting down just a minimum on conventional loan?
That's 3%, that's $7,500. I'd probably set aside another $7,500 for netting closing costs, probably walking away with $15,000. And if that's too tough, there are ways to kind of bring that number down. There's lender credits, there's seller credits, there's down payment assistance. There's all kinds of things. You and I literally just had a transaction a few months ago in which I think they bought the house for a total of what, like $2,000? I don't remember the exact amount.
I did the math on it. They spent less than $2,500. Inspections, loan, everything. They brought $370 to closing.
They used a down payment assistance program because that's what worked for them and their family. And those are real life examples of what can happen. So, but without that, yeah, absolutely. On a $250,000 house, 3% down, a conventional, another $7,500 or so for just closing costs between insurance and attorney and et cetera. That's a totally realistic number for somebody. I think the thing that people should take away is it's more attainable than you think, especially with tax season around the corner. A lot of people, especially a lot of our W-2 employees, they're getting refunds, things like that.
Yes, they are.
And that's a great time to set something like that aside for a down payment.
I agree. As we're sipping on the remainders of these little bits here, is there anything else in regards to pre-approvals, preparing to buy, from a lending side of things that you really think our viewers should know?
More than anything, I think it's just don't be afraid to have a conversation with a lender, especially like a well-educated lender, somebody who is going to tell you the truth in your situation. There's no value to putting your head in the sand. I think when it comes to home ownership, which is a key tenet of long-term wealth building, it's good to know exactly where do I stand relative to where should I be, or is the time now, or is it later? Well, how long? Any wise person, any financially sound person will always tell you one of the building blocks of doing so is real estate. And figuring out when that is the right time for you is going to be a different answer for everybody, but it does not mean that you should hide from it.
I love that. Phil, Chicagoland area, you obviously can help. That's where I'm centered. If you guys are looking to buy a house this year or even next year, and you want to have a conversation with someone who's going to evaluate things and treat you fairly and honestly and not give you the runaround, Phil is the guy that's going to do this. So I'm going to put his information and how to get a hold of him in the description to the video. You can also find his contact information through my link tree on Instagram. We'll be tagging him and his account there as well. So definitely reach out to him. Now, if you're outside of Illinois, Phil, what other states can you help in?
Every state but New York.
There it is, people. As long as you don't live in New York, you can get the expert help of Phil Bukowski and his amazing team. He's got a great group around him. And I can promise you, when he tells you he can get it done, he can get it done. Well, Phil, thank you so much. This has been fantastic. I know everybody is going to find some sort of value in there. And obviously, there's a lot more stuff that we're going to have to loop back around on. There will be more episodes about the financial side of things and a lot more whiskey to drink.
Amen, brother.
Hey, cheers.